Today's training class will cover the reports available through Total Planning Suite for Golden Years cash flow. Total Planning Suite uses a single input in the database to deliver two different planning approaches, and today we're going to be focusing on Golden Years, which provides a highly detailed cash flow analysis to carefully evaluate and measure the impact that cash flow shortages and surpluses have on the client's assets over time. Golden Years provides an optimized cash flow planning approach. So now that I have the program open, once you have selected your client and you're within the input for a scenario, you can generate your Golden Years reports. When you do choose to generate the reports, you can pick and choose the pages that are generated. If you go under the report selection, Golden Years report, here's where you can make the selections using some of the default templates that are available. This is a great place to start if you wanted to start with a basic report set. That's a great starting point, limiting the number of pages to kind of the most important pages. For today's class, we're going to look at the entire set of reports, so every single report available. Having the entire set of reports is very handy when you're trying to track through the numbers and the calculations, so I do recommend you generate that full set of reports, and then you pick and choose, narrow it down to the reports you want to deliver to your client. You can create your own list of custom reports by going into this Create and Modify Custom Report and selecting the pages that you would like to create for your client's plan. So I'm going to go ahead and generate the reports, and then what will happen is they'll open up in a separate window. So I've actually already generated the reports, so I'm just going to pop them open here. And you'll notice we land on the cover page to start. You can see the different sections that are covered in Golden Years. So there's an introduction, cash flow, assets, taxes, estate, summary, real estate, and then a data input section. So we'll cover all those sections in today's class. You'll notice also there's a total of 153 pages. Once again, I chose to generate that full set of reports, so every report available is included in this. We can again narrow it down to the reports you would want to present to your clients by using that report customization feature. We're not going to talk about every report page today, but we'll try to highlight several of the pages. So to start with this cover page, you'll notice a few things that you can customize. The first thing is the color and the font that's used for your report, so not only your cover page, but all the reports thereafter. You can also include a logo. So if we look back at our input here, under report options, this is where you can choose the report font and that heading color. So in this case, we're using Calibri with a blue color. Also, if we pop back over to the reports, you'll notice where it says personal retirement analysis for Robert and Karen sample. If we look back at the input again, this is going to be under the assumptions scenario information. You can see where it says the client's name for the cover under cover name. Golden Years title is blank. If you leave that blank, that is going to use the default title. If not, type in your own title and it would use what you've entered here rather than that default. The other thing to show you about the report cover page is the 6 lines of advisor text that show up on that bottom left-hand side. So this is where you're going to enter in your contact information for that cover page. Any of this information found in assumptions can be set up in your default settings. So under Tools, Settings and Defaults, if you populate the information there, every time you create a client file, it will be pre-populated for you, so you won't have to make as many adjustments in your specific scenarios that you're working on going forward. Okay, so that 6 lines of cover page text I was just referring to is this here. Alright, so then we'll just move on down. If we open up the cover section, you'll see that there's a table of contents. That's again something that you can have selected back at the input here. You'll notice the report page options for items like including audit trail notes, which we'll talk about in a little bit. Things like scenario names on the reports, if you want that table of contents, if you want page numbers. So those report options are also available under that last tab in the assumptions section. The next section is the introduction section. This is going to give a summary of the assumptions used in the analysis, and it will also provide a net worth statement. I'm going to be skipping the text reports, however I do want to highlight this cash flow planning page. This is a great report to read to understand the underlying assumptions that are used for the cash flow planning approach in Golden Years. Easy Money has the same report except dedicated to goal-based planning. So if you want to take a look at that as well, you could compare and contrast some of the differences between Easy Money and Golden Years and how those calculations work, what they're ultimately focused on, and those important underlying assumptions that are different between the two projections available through Total Planning Suite. So for Golden Years, this is going to be an optimized cash flow planning approach. So it's going to carefully account for all income sources and expenses to determine if the clients have a shortage or surplus in every year of the projection, and it's going to illustrate the impact that those shortages and surpluses have on the client's ability for their assets to last through their projection or through their life expectancy. And it also takes an optimized approach, and by that it's going to pay very close attention to all the details. So any returns on your assets, for example, if we take a look here, interest, dividends, capital gains, and appreciation, those returns would be automatically reinvested, and so that full return would be reinvested into the account every year. Taxes aren't charged on the earnings, they're actually instead part of the client's expenses. So if they can be covered by the client's cash flow or other income sources, they would be. And then the full return would be able to be reinvested into their assets. Also with taxes, it's going to do a full tax calculation every year. So rather than coming up with their current tax rate and using that tax rate throughout the projection like we do in Easy Money, this is actually going to run through the full tax breakpoints for federal and state taxes every year. Also include things like AMT, anything like the net investment income taxes, the new 3.8% on Medicare, the amount of Social Security that's taxable every year. So we'll have all those rules built in, and it will go through the full income tax calculation each year. So some of these other pages here, important assumptions for the projection. You can review those and make sure everything looks correct for you and your client. The net worth, so we can see this is a graphical, this is the numbers view of the net worth. We can see the detail of the assets that are entered and liabilities to come up with their net worth. This is the ownership style, so we can see the net worth is broken down by owner. There are 4 different styles of net worth available, so you can take a look at the different options and see which one works best for you and your presentation style. If we look back on the same report options tab we had visited earlier, we can see the net worth, and this is where we can choose the different styles. So bank style has the assets on the left, the liabilities on the right, with a traditional bank type format. Consolidated gives you just a single row of all their assets, debts, to come up with their net worth, and then there's also an express view. So you can change that, run the report, and see which one you prefer. So we have the net worth statement followed by the net worth graph. So we can see a graphical view of their net worth situation for the current year and a quick summary of the numbers used below. Then we get into asset details and some other details including personal property, liabilities, insurance. We won't go through all those items, but I do want to point out a few things on this asset details report. Let me zoom in here so we can read some of this text. So you'll notice this lists a description of each one of the assets, the value, the additions, the rates of return, owner, liquidity, group, class, type, and retirement. So I just want to point out a couple things here. For monthly additions, you'll notice for Karen's 403B, we can see additions to the left and to the right of the slash. So anything to the left is personal contributions that the client's making to this asset. Anything to the right is going to be company additions. So in this case, she's putting away $175 a month towards her 403B, and her company is making a matching contribution. Other thing I want to point out is this retirement column. In most cases, this will be yes across the board here. And if it does not say yes, that means that the check if used for retirement box is unchecked on the data input. So if we take a look back at the data input under asset details, it's going to be this checkbox right here, check if used for retirement. If you uncheck this box, that means that that asset would only be used for the client's current year net worth, and it would not be included in the projection going forward. That might be appropriate if it's something like a business asset that they're going to be selling in the future and you're recording the income stream at that point, so you just want to capture it as kind of a placeholder for their current year net worth. But in most situations, it would be an asset available for spending in the retirement situation, and if that is the case, you want to make sure to check this box. Okay, so one last thing on this report, you can also choose to sort by different styles. Right now it is sorted by description, so it's alphabetical, which is the default. Again, if we look back on our input on that report options tab again, This is where you can choose the different sort options. So you can really sort by most of those column headers. Okay, so then let's see here. There is a report talking about how to use the audit trail in this introduction section as well. This is a great report. The audit trail is a super helpful feature available in both Easy Money and Golden Years. But this gives you a description of how it works. It's very straightforward, though. I'll just explain it a little bit here. You'll notice each one of the sections starts with a letter followed by the report page with a number. So the introduction sections are the A's, cash flows are the B's, assets are the C's, and so forth. So to show you how this works, if we want to take a look at, I'm going to jump ahead a little bit, but if we wanted to look at their cash flow illustration, which shows their year-by-year income sources and expenses, you'll notice there's a report. It says B7 on the top right-hand side. You can also see it on the left-hand side navigation item. But if you scroll down to the bottom of any of these columns, it's going to give you this is the audit trail reference. So if we wanted to get a breakdown of earned income and how that's changing and the details behind it, we can look at report B9, which is earned income. So it's going to break that sum number up into individual 1 salary, self-employment, and individual 2 salary and self-employment income. If we were to do the same thing for this living expenses and taxes column, it would tell us to go look at report B8, which is the annual expense illustration. And so you can see a breakdown of their total expenses, whether it's personal, insurance premiums, debt payments, account deposits that they're making, other expenses, itemized deductions, or income taxes. And we can continue to break those numbers down as far as they can using that audit trail reference. So it's a very handy feature. So again, you can choose to turn that on or off back on that same input under Assumptions and then that Report Options tab. So the next section is their cash flow section. This is going to be focusing on their income sources and expenditures. So it's going to take careful tracking of all the inflows and outflows of cash. First, we start with a graphical view of the cash that's needed versus available. So this is really a graphical view of what we can see on the number schedule for the cash flow illustration B7. So if we want more details, that's a good report to look. But this gives you a good overview. You can see their income sources versus their expenses over the years. So we can see we have several years where there is a gap between what they have available, especially once they get into retirement and are receiving some green, which is pension and Social Security income, and no longer earning income. And that gap would have to be filled with distributions from assets, which we're not really looking at this point. We're just looking at scheduled income sources versus expenses. The next report looks at sources of funds. So where we saw gaps on the previous page, this is going to show the distributions that the program's going to be making to fill that gap. So those years where we had gaps between our income needed and income available, it's going to take distributions you can see in blue here from investment accounts, or from yellow are going to be distributions from retirement accounts. So we can see they still have investment money, but the program's going to be starting to take some RMDs, and then once they run out of their non-qualified investment type money, it's going to start taking distributions from their retirement accounts. Okay, and then the next report we have here, still continuing with the set of graphs, is the annual expense graph. This just gives you a breakdown of what makes up their annual expenses each year of the projection. So we can see, for example, at this point we have a large debt payoff, so it's probably a balloon payoff of something like a residence. Again, we can get to the more details to break down the numbers if we were to look at the annual expense illustration B8. So next we get into their current year cash flow. So this gives you a real careful, detailed view of their current year situation. It's going to line by line list every income and expense item for the current year only. So you can see their income sources, all of their expenditures, things like taxes, loan payments, insurance premiums, contributions to their assets, education fund deposits, contributions for charitable giving, property taxes, medical expenses, laundry list of budget items here. So in golden years, if they do have a cash flow surplus, that surplus would turn around and be reinvested. If they have a shortage, that shortage would get pulled from their assets in the current year, regardless of the retirement period. There is an option if you want it to behave a little bit more like Easy Money, which ignores pre-retirement cash flow. You can choose to do that. That is under The surplus allocation tab, golden years only, you'll notice ignore pre-retirement cash flow shortages and surpluses. People don't typically use this function, but you can if you want that pre-retirement period to ignore any cash flow shortages and surpluses. So the next report is that detailed cash flow illustration. So this is going to give us all the numbers behind what makes up their income sources and expenditures year by year, and determining if the client has a cash flow shortage or surplus. So in this case, they have surpluses for the first 3 years, and then we can see they have a small shortage and a little bit of surplus, and then the shortages get larger from there. And it looks like that's primarily because of a change in earned income. So probably individual 1 is retired, and then individual 2 is retired a few years later. Again, we can break that down out and find out exactly why by following that audit trail reference. So any shortages that you see here will get pulled from assets. If they have a shortage here, it doesn't mean that their assets are depleted. It just means that their income sources, their scheduled income sources, do not exceed their expenses. So their expenses are more than their income sources for that year. So in the next report, these are going to really be supporting that B7 cash flow illustration. The annual expense illustration, we can see a breakdown of how their expenses change over time, how their earned income changes over time, pension and Social Security income that they're receiving, other income and expense detail, miscellaneous cash flow items from things like rental real estate. And then we get into financial goals, and financial goals are one-time special expenses that have been entered in a specific input for the program. If we look back here at our data entry and go to the financial goals section, you can see this is where the retirement trip and the sailboat have been entered into the system. If you do want the expense of the retirement trip and the sailboat, in this case, included as part of the expenses for the client in the future, you can check this box, include financial goals and retirement capital estimate. That means we'll see this inflated $15,000 come into the projection as an expense at age 61. If we did not check that box, it would still be highlighted on this goal funding financial goals report, but it wouldn't be an expense included in the retirement projection. So this goal funding report, if you do enter in any financial goals there, it will come up with the lump sum the clients would have to put away today to fund that goal, or if they were to make monthly deposits from now until that age of the goal, what kind of monthly deposit would be required. So we have just a couple basic education funding reports. There's 2 of them available in golden years. And this is just going to illustrate the education funding requirements, so you can see the college costs for each child that have been entered in the system for the years that they're occurring. Then the program will also help solve for shortage solutions in this case, so it will take a look at what kind of current funds they have available now, what kind of deposits they're currently making, and it will come up with the amount of additional funding that would be required. So if we take a look at what they have now, considering they have $25,500 saved, and they're currently putting away $145 a month for education, it's going to say that they need to increase their contribution by $407 a month in order to completely fulfill their education funding requirements. If we move on to the next page, education funding sources, this is going to show how their current education funding is going to work. So you can see their education fund balance, so they indicated they had this $25,500 already set aside for college, and they're making that monthly contribution, so you can see how that annual addition occurs each year of the projection. The annual college costs are going to be factored in, and then we can see what's actually pulled from the education funds. So when those education costs start to incur for the children, the program's first going to pull from the funds available. After those funds have been depleted, it's going to start pulling from the parent's assets, or it's going to be an expense at least included for the parent's projection. If you have this box checked here, so if we look under dependents, this checkbox, deduct education expenses from savings and investments, if you have that box checked, any uncovered college costs will get passed on as an expense to the parents. If you do not have that box checked, you'll have the education funding illustrations, but that expense that we see here, this from assets column, would not be carried into the parent's expenses. So that covers our cash flow section. Then we move on to the asset section, and this is going to give you details of the client's assets, and you're going to see all the changes in those assets with additions, withdrawals, the return that they're earning. So all those pieces will be covered in this asset section. So like the cash flow section, we're going to start with a couple of graphs. First is the account summary graph. You can see how their total account values change over time and kind of a colorful representation of how their different accounts change over time, whether it's taxable, equity, tax-free, tax-deferred, or retirement accounts. So we can see they're depleting most of their assets other than they have some retirement accounts remaining at the end of the projection here. You can also adjust how the program reinvests surplus cash flow. So if we take a look back at our data input here, under assumptions, surplus allocation, this is what the program is going to do with any surplus. So prior to retirement, in this case, we have 20% of that surplus going into a taxable account, so a taxable savings type account, 80% of it going into equity and other, so things like investment accounts. After age 65, that is changing to 40% taxable and 60% equity. So you could just click on Edit Allocation to change how that surplus is treated and reinvested by the program. So then we have an account summary. This is the number schedule that's going to be supporting that graph we just saw. So you can see how those account balances are changing over time. And so you can see also the total on the far right-hand side. Again, we can use the audit trail to break any of these numbers down. Several of the reports in this asset section are really going to be supporting the numbers that you see here. So if we wanted to get a detail on all the elements of the taxable account and how that's changing each year, we can go to report C4, which is the next page. Oops, excuse me, it's actually, we have a total assets account first before we get into there. So let me talk about this one and then we'll take a look at the taxable accounts. Total working assets is going to just combine the assets into one category, but we can see all the pieces that are impacting the account balance at a high level here. So for their total account balance, we can see any contributions being made to those assets, and we can see any withdrawals coming from the assets, whether it's scheduled withdrawals, cash flow shortages or surpluses, or RMDs, and then we can see the rate of return, the total return they're earning. So if we add these across, this would give us the elements to see how that total account balance is changing year by year. Moving on, then now we have the detail for their taxable accounts. So the program groups the assets by their type, so all taxable accounts get tracked together, equity and other accounts get tracked together. So that's what you'll see on these reports. Here you can see all the inflows and outflows affecting the taxable accounts, so the beginning year balance, any deposits, cash flow shortages or surpluses, withdrawals, the rate of return it's earning, and any taxable income that would be generated that would be factored in for their income tax reports. So we do that. You can see the differences here for taxable and equity and other. For equity and other, we're looking at interest, dividend, capital gain, and appreciation. So the program will tax the different returns accordingly. And you can see that factored in on the far right-hand side as well. It's going to keep track of capital gains as well. So if they have, for those equity and other accounts, it's going to keep track of their cost basis ratio and change of basis, and it's going to know the annual capital gain or loss that needs to be factored in for those calculations. You can also have a loss that gets carried forward in the projection, so it knows the loss carry forward rules, so you can have that factored into your calculations. So next, just like the taxable account and equity and other, we can see the details for tax-free accounts, tax-deferred accounts, and then we get into retirement accounts. So individual one's retirement accounts here, we can see RMDs kicking in at age 70, individual two's retirement accounts, Roth accounts, and in this case we also have an inherited IRA included. Then we get a summary of the retirement plan. So this groups the total retirement type assets or qualified type assets together, so you can see a detail of how that balance is changing with contributions, withdrawals, return, and RMDs, which are also included here. Next, we get into stock options. So if you have entered any stock options into the system, the program will keep track of what you've entered to determine the cash and tax effects of exercising and selling those stocks. So we can see the cash from sale, and we can also see the reportable amount for taxes. This is kind of a summary, as you might guess from the title. But then we have a more detailed breakdown of those stock options, so you can see how those numbers are calculated for that summary report. Next, we get into asset allocation. And asset allocation is going to be taking a look at how the clients are currently allocated versus a suggested allocation. Asset classes can be fully customized as well as the suggested allocations. So you can see the different class names here: reserve, income, growth, and income. So you can customize these to the asset classes that you use in your planning practice, and you can have up to 21 total asset classes. When the program goes to choose the client's custom allocation that we see on this column, it's purely looking at the risk tolerance level selected for the client, which in this case, this client has been set as a conservative investor. So it's choosing this column as their custom allocation. You can override that as well if you'd like to do something different. For the specific plan you're working on, if you look under Asset Summary, Allocation tab, you'll notice this Proposed column, so you can use that instead, and it will use the proposed rates you've entered as their custom allocation. Next, we just have an asset allocation graph, and it's going to show how they're currently allocated versus a suggested allocation. This is followed by a more numbers view that's going to tell the clients how they would need to move their funds in and out of the different asset classes to come up with that suggested allocation. There's some information on risk and liquidity in this program as well. So you can see for liquidity, you can see the client's liquidity ratio for their total assets, as well as just their working assets, which are going to be purely investment assets. The liquidity that you're entering on the data input is used purely for this report and the following report. So back under asset details, where you're choosing liquidity, this is the report this is going to be used for. The next report, the final liquidity report, is just going to give a quick description of each one of these liquidity types. And then again, you can see those same ratios of their total assets, liquid assets, and their liquidity ratio. Then we get into some details of their rental real estate. So if you have entered any rental properties, like stock options, is going to calculate the cash and tax effects of having rental real estate properties. So we can see the details of the property that's been entered. In this case, one property's been entered. We can see the total market value, the income generated from the rental property, the expenses associated with it, as well as how the mortgage information and how the balance is changing over time. The next report is going to show you the income and tax analysis for the property. So it's going to show you things like depreciation, taxable income, their net cash flow, the tax amount due or saved, and that's all going to be folded into the analysis. So it will include the cash pieces as well as the tax impacts and fold that into the main planning projection. Next, we get into the income tax section. So you'll notice this is a pretty large section. And that's because Golden Years is very detailed when it comes to the tax calculation. So it's going to do a full detailed tax calculation every year. So if we take a look at their current year situation, this is kind of like that current year cash flow where we're going to see the income and adjustments and itemized deductions in detail line by line. See everything that makes up their income sources, any adjustments, itemized deductions, standard deductions, personal exemptions, taxable income, and then their total taxes due broken down into federal, payroll, other, and state income taxes. We can see a graphical view of their total taxes over time in blue compared to their spendable income, how that changes for them in the projection. We can also see a tax versus expense graph, so you can see what portion of their total expenses goes to taxes. Next, we get into the tax summary, and this is going to show them total taxes year by year. This is the amount that the program will have included in the client's expenses. So we can see a breakdown of how that total tax number is generated by looking at this report, whether it's federal, AMT, state taxes, payroll taxes, and we can see again more information if we use the audit trail. So if we wanted to get a breakdown of the federal income tax, we would go to report D8, which is in this same section, Federal Income Tax Worksheet. So you can see the marginal tax breaks that are used for the calculation. One thing I do want to point out here, filing status, where it says joint all the way down, that's good. If a death occurs, it will change to single. If you ever see this joint for the first year and then single after, that means you probably do not have the check if married box checked. So if we click on the client's information, it's just this little checkbox here, check if married. Make sure you have that checked. Otherwise, you would see it change from joint to single after the first year of the projection. The other thing I'll point out here is the marginal tax brackets. These can be indexed, so this is the current 2014 marginal tax brackets. Typically, planners will want this increasing at a rate similar to inflation, assuming that the breakpoints and exemptions will go up over time with inflation. So in this case, I don't have that set, but if we do want to set it, we go back to the input under tax data, and then you'll notice on this filing status and options tab, you'll notice index rate for federal tax tables and exemptions. So that's 0, but typically you want to put a rate close to inflation in there. Okay, I skipped a couple of pages, so I'm going to go right back up here. So we were looking at tax summary. Let's go down to the next report, which is taxable income analysis. This is going to show you their gross income, AGI, and then their taxable ordinary income each year, and any net dividend capital gain type income. So again, you can get all the details you need to by following up any of these columns using that audit trail reference to get a breakdown. The program has all the rules built in for things like exemptions and itemized deductions, so it will have all those calculations that you need to come up with an accurate tax analysis. So you can see everything that makes up their interest, dividends, and capital gains. That federal income tax worksheet we were on just a moment ago. Any adjustments to income for things like qualified plan contributions that they're making, if they're paying self-employment taxes, alimony, self-employment medical insurance premiums, itemized deductions and exemptions, as well as phase-outs. So the program does have the phase-out rules as well. It does do a full AMT calculation every year, so the program is going to factor in AMT if the client does indeed have an AMT situation and that's a tax that they need to pay. If early distribution penalties were coming into play, those would be factored in. You can see a breakdown of the FICA worksheet, so wages, self-employment, hospice insurance. This will include that 3.8% on the net investment type income as well, which was new for 2013. We can see how much of their Social Security is taxable every year, so the program is going to run through that calculation. And then we can come up with the state taxes. So the program is going to pick the state taxes based on what you have entered in your program settings. So you can see where you select the state for tax purposes. You do need to enter in the state tax information, including the breakpoints for the state where your client resides, under Tools and Settings and Defaults. So if we look here at state taxes, Oregon, all this information has been set up, so the program, when it goes to calculate the state taxes, will look here to provide the breakpoint information. So you do need to set this up to have your state taxes included. More information about their taxable earned income, and that's it for the tax section. So moving on, then we have an estate section. And the estate section is really going to look at their current estate situation versus a suggested estate situation. So starting off with their estate details, this is going to list any of the estate strategies that they already have in place and give them what their net worth is for estate planning purposes. And then we're going to have a graphical view of what their taxable estate would be in the current year if individual 1 were to die first, or if individual 2 were to die first, and what their tax situation might be for their current situation or with trust situation. In this case, there's not too much to see. They don't owe any estate taxes in either case with just under an $800,000 estate. But it does go through the numbers here, so you can see a detail of how those estate taxes are calculated. This first column is looking at if individual 1 were to die in the current year, followed shortly by individual 2's death. So we can see the without trust column and then the with trust column, and the with trust column is going to move anything it can into a credit shelter trust and any insurance into an ILET. So that's the difference between those two columns that you see here. Again, there's really no state taxes due in this situation. They do have a little gain if they they take advantage of a credit shelter trust and an ILET, which is in this case purely saving them on administration type costs between their estate projections. The program's also going to detail out what we just saw on the numbers page in a flowchart, which can be a little bit easier to read, so we can see everything that makes up individual one's estate that gets passed through marital transfer to individual two. And we do the same thing for the next individual if Karen were to die first. We have the same flowchart, except for this is modeling that with trust situation, which is going to fund a credit shelter trust and move insurance into an ILET. The program will also evaluate estate costs for every year in the future, so it might be a situation where they don't have a big estate situation now, but they might be running into it, especially if their assets are growing in the future projections. So you can see year by year, maybe they don't have a current situation, but it's something that they might need to plan for in the future. And then we give some more information with graphs of how those estate taxes might be changing over time. There's several estate illustrative type reports, so these are going to be helpful reports if it's an area that you want to discuss with your client. They're purely illustrations, so they're not modeling anything specific, but they're good informational type pages. So the last set of estate reports are these estate planning options pages. This allows you to evaluate a specific age of death. If we look back at our input here, under estate values tab, you can enter in an illustration age of death. And you can also enter in gifting. When you enter this information, it's going to be used purely for this set of estate planning options pages. So we'll look specifically at that year and include gifting. It gives you an illustrative type report as well, a graphical report. So then we can see some more detailed breakdown of how their assets and the values used for the estate planning reports are projected each year going forward. And getting down to it here, next we have the summary section. This is going to tie all those pieces together. We're going to look at their overall ability of their assets to last throughout the projection. So we can see a quick summary of their goals, things like other income, retirement income, taxes, retirement analysis saying that their assets in this case may last through life expectancy. We can see a graphical view of how their capital is projected to change over time. So in this case, we can see it does last through last life expectancy, even though it does start a downward trend once they get into their late 70s here. We can also see their annual expenses compared to that total capital available. Then we get to the retirement capital estimate. So this is a great report, one of the key reports available in golden years. This report works really nicely with the cash flow illustration that we saw back on B7. So this report, where it looks purely at scheduled income sources versus expenses and shows you a cash flow shortage or surplus, this report is going to essentially show you the solution to those shortages. So if we look here, you'll notice we have no more shortages. Surplus is still displayed, but for those cases where they didn't have as many scheduled income sources as they would need for their spending requirements, this is going to show the distributions that the client would be making. So distributions from things like investment accounts and their retirement accounts. And essentially it would continue to make those distributions as needed throughout the projection. And you can see how that total account value changes year by year through the projection. Again, that audit trail is a great feature to use to break down any of the numbers that you would need more information on. So next we get into the Monte Carlo. So F3, again, fixed case. We saw that they were making it to their last life expectancy with about $100,000 to spare, so not a big cushion there, which is going to be illustrated for us on the Monte Carlo. So we can see the blue line. This is their results using that fixed rate of return that we just saw in F3. And then we can see those little gray lines, which represent a sample of those 10,000 simulations that are run using the random rates of return. So you'll notice the fan of results here, and the original retirement capital estimate, they ended up with $100,000. That was that fixed case with the fixed rates of return. The worst case of those 10,000 trials, we can see they run out quite earlier, is 0. The average is about $500,000. The maximum, so at least one of those 10,000 trials, they ended up with about $5.4 million. The percentages on the right-hand side, people like to take a look at these. The percentage of results above 0 is 59%. That's at that final life expectancy, and that's the number of those trials that never hit 0. So about 60% of those trials were successful, which means the other 40% did run out of money and they did hit 0 before life expectancy. It also gives you 3 other ages, so you can see how that percentage changes throughout the projection. In little teeny font here, you can also see the standard deviation that's used. So you can see the portfolio rate of return, the standard deviation, and then you can see what the 95% of the rates when it's using those rates of return will fall between when it's varying those rates. So in this case, negative 2.74% and a high of 16.39. The program will go out a total of 5 standard deviations, but this represents the first 2, which makes up 95% of the rates that it will use. Okay, so next we have a net worth statement. This is a very handy report. So where we saw retirement capital estimate F3, they ended up with $100,000. That was their savings and investments and retirement type assets. It didn't include personal property, rental real estate, insurance, cash values. So we can see here how their total net worth is changing, including their total liabilities, of course. So at last life expectancy, given their property and the like, they have closer to $1 million. There's also some supporting detail to that net worth, which is going to list out the details that make up their total personal property. The last item for this summary section is the withdrawal rate reports. And this is going to calculate the net withdrawal rate each year. So it's going to look at their total funds available, less any withdrawals that they're taking for things like RMDs or shortages. And you can see how that withdrawal rate changes every year of the projection. There's also a graphical view of that. So if we look at the bottom here, this shows them the moving average withdrawal rates. So you can see it as a 1-year, 3-year, and 5-year, and 10-year average range. So we can see their average withdrawal rate over a 10-year period is about 7.84%. So that's the summary section. This is a great section to focus on as it ties all those pieces together for the client. The very last section is more detail for the real estate pieces. So if you've entered in rental real estate property, if you had multiple properties, this is going to break out the income and expenses for each one of those properties, which we saw summarized back in the asset section here. So that's a summary of all properties. This is a breakdown of the individual properties. And the very last section is client input. This is a quick place where you can just review the information that's been entered into the program. So I think that is everything I wanted to cover for today's Golden Years training class. And again, this is that full list of pages. If you're looking for a more basic report set to start with, I do recommend you going back to the data input, running Golden Years reports, and choosing that basic with Monte Carlo would be a really great place to start. It's going to give you a much smaller set of reports to focus on. Thank you very much for taking the time to join our class today.